Another major category of anti-deferral under Subpart F deals exclusively with the balance sheet. It basically deals with foreign companies investing in U.S. assets. I'll use the code section, which I try and avoid, but people are fairly familiar with this. This is section 956. 956 dealing with investments in U.S. property. And I'll give you a simple example, and the simple example I think is fairly simple to understand, but then we'll go through a series of modifications to the simple example to show you how convoluted this can get and how easily companies can get inadvertently trapped in this anti-deferral issue and sometimes have no way out of it. But let's start with the most basic of examples. I have a U.S. parent company. U.S. parent company in turn has a foreign subsidiary. Again, the foreign subsidiary has to be a controlled foreign subsidiary, which I'll assume that is the case. And basically what happens is the foreign subsidiary runs its business, and I'm assuming the foreign subsidiary has no other income that's considered abusive or would otherwise fall under the anti-deferral rules, and it's just running like it would any other normal foreign subsidiary. It earns its income, it's subject to local country tax maybe, but at the end of the day it's not subject to U.S. tax until there's a dividend. Well, at the point in time where there's a dividend and the dividend comes up, under the U.S. rules, the U.S. shareholder now has income from its stock investment in the foreign subsidiary. This is taxable income. You're going to pay tax on it. And the taxable income is because you have an asset that's generated some income. Income gets reported on the U.S. return. Inevitably, there are sophisticated taxpayers who learned prior to these anti-abuse rules that instead of making the dividend, if I own 100% of the foreign sub, and let's say the amount that we're talking about is $1,000, that I could do one of two things. I could pay a dividend for the $1,000, taxable in the U.S., or alternatively, what I could do is make a loan. And if I made the loan, economically speaking, the $1,000 is still sitting up here in the U.S., but it was a balance sheet only transaction. And to kind of think about this in terms of accounting, for the foreign subsidiary, right, the accounting is, let's see if I can remember this now, debit note receivable, U.S., credit cash. And on the U.S. side, it would be credit cash, right? I have the cash now. And I'm going to debit note payable, note payable, foreign. And at the end of the day, you can see that on the U.S. side, none of this goes through the income statement. It's a good result. Clearly abusive. So what the U.S. rules have worked to stop is exactly this transaction. So in the case of a controlled foreign corporation that makes a loan and the obligor on the loan is a U.S. party, it's the U.S. parent in this example, then that's considered an investment in U.S. property, and it's treated as if it were a dividend. Treated as dividend. It's very straightforward. I think this is fairly easy to see and to get your arms around. But let's talk about some ways just to show you that people are creative and sometimes you can end up with some other answers. It would be equally possible to have your foreign subsidiary, right, turn around and go to the bank and make a deposit. Okay, the deposit into the bank is an asset of the foreign subsidiary, and that in and of itself is not considered a dividend to the U.S. In fact, let's say that the bank is a foreign bank. We'll just make it super simple. It's a foreign bank. Well, then the U.S. can go out and borrow, and I'm going to use the same $1,000 example. They deposit $1,000, U.S. borrows $1,000, and if the borrowing, if this balance is economically connected to this deposit, such as a restricted account or a compensating balance account, then this is considered to be just as if the foreign subsidiary had paid the dividend or invested in U.S. property this way. Again, looking to mitigate the creativity that taxpayers will have to circumvent these rules. Let's give some other examples just for the fun of it. So if I have a scenario where the U.S. company now understands that if I go out and borrow from the U.S. or from the foreign, in other words, foreign subsidiary loans to the U.S., that's a problem. So what the U.S. does is it goes to its bank and it borrows money. The bank says, well, we'll lend you the $1,000, but we're a little bit nervous of the fact that you are you need the money, we don't have access to it, so what we would like you to do is collateralize this $1,000 loan that we're giving you with the assets. So we'll take accounts receivable as collateral, and we'll take inventory as collateral. Well, if you take a U.S. loan and you collateralize it with assets of the foreign subsidiary, that's just as if the foreign subsidiary had made the dividend to the U.S. So that again, this falls under Section 956, investments in U.S. property. You need to be careful here though, because if you notice in this particular transaction, nothing's showing up on the financial statements. This piece doesn't actually show up. The only thing that shows up on the financial statements is the loan from the bank. You'd have to look in the bank documents to see that it's collateralized by the foreign subsidiary's assets. So then you kind of keep moving down this path. Well, let's say then that we take away the accounts receivable and the inventory, because I don't want to collateralize it with the assets of the foreign subsidiary. What I'll do is I'll collateralize it with the common stock of the foreign subsidiary. In other words, the bank will lend me the money, I will collateralize it with, and I'm sure if you've done financing and borrowing, you've seen this, but it's all the assets, all assets of the U.S. company. Well, the problem is that one of the assets of the U.S. company is the foreign sub common stock. That effectively triggers then this same $1,000 dividend coming back up. So in each of these cases, you can see that the rules are there to circumvent creative taxpayers and trying to get around this. There are probably another dozen examples that we won't go through, but just be aware that anytime you're using your foreign subsidiaries to collateralize a borrowing, or even more directly if you're using the assets of the foreign subsidiary in the U.S., such as the cash or other things, AR inventory to collateralize borrowings, or if you're doing, like in the example of doing a compensating balance with the bank, just be aware that generally is going to result in an investment in U.S. property. Now, the investment in U.S. property may or may not be taxable. There's a separate set of rules on calculating that, but you're at least right square within the definition of Section 956 property. So with that, I thank you.